Hey, welcome to CFA by NK, a podcast where we make sense of finance, simplify the CFA grind, and turn coffee-fueled nights into top-tier results. I'm NK, your CFA buddy, guide, and fellow finance nerd, here to help you smash those exams and maybe even enjoy the ride. If you're aiming for that CFA charter with confidence and minimal stress, you're in the right place. Let's get smarter, sharper, and one step closer to those 3 golden letters. This is CFA by NK.
Summary of the key standards. 1. Standard I. Professionalism o integrity of capital markets o duties to clients o duties to employers o investment analysis, recommendations, and actions. 2. Standard II. Integrity of capital markets o insider trading o market manipulation. 3. Standard III. Duties to clients o loyalty, prudence, and care o fair dealing o suitability o performance presentation o preservation of confidentiality. 4. Standard IV. Duties to employers o loyalty o additional compensation arrangements o responsibilities of supervisors. 5. Standard V. Investment analysis, recommendations, and actions o diligence and reasonable basis o communication with clients o record retention. 6. Standard VI. Conflicts of interest o disclosure of conflicts o priority of transactions o referral fees. 7. Standard 7. Responsibilities to the CFA Institute, members, and candidates o conduct as members and candidates o reference to CFA Institute and designation o candidate examination integrity, blank, underscore, blank. Important takeaways. As a CFA candidate or charterholder, you are held to the highest ethical standards. Understanding and adhering to these standards will not only help you pass the exams but also make you a trustworthy professional in the field. Ethics is a significant part of the CFA exams. It is crucial that you understand and apply these principles in your studies and professional life. Blank, underscore, blank. Final tips. 1. Practice makes perfect. Ethics questions are tricky, so practicing with mock exams and questions is key to mastering them. 2. Consistency is key. Review the ethics standards regularly to keep them fresh in your mind. 3. Real-world application. Try to think of these standards as not just exam content but principles you will use in real-world scenarios as a CFA professional. Blank, underscore, blank. Next steps. You're now ready to move on to the next major section of the CFA curriculum, which will be focused on quantitative methods. This section introduces tools like statistics and probability that are essential for the CFA exams and real-world financial analysis. Blank, underscore, blank. Mini quiz. Answer before we move on. 1. What are the main duties you have toward your clients as a CFA professional? 2. Why is it important to follow the CFA Institute's standards and ethics guidelines? 3. Can you explain the importance of prioritizing your clients' interests over your own? Once you've answered these questions, say, ready for quantitative methods, and we'll dive into that subject. You've done great work so far. Keep it up. Let's move on to Week 2 Lecture 1, Quantitative Methods. This will be a critical part of your CFA studies, as understanding quantitative techniques is foundational for financial analysis and decision-making. Blank, underscore, blank. Lecture 1, Introduction to Quantitative Methods. Quantitative methods in the CFA curriculum are crucial for analyzing investment opportunities, assessing risk, and making decisions based on numerical data. In this section, we'll cover essential mathematical and statistical tools that you will use throughout the CFA exams and in your professional career. Blank, underscore, blank. 1. Time value of money, TVM. The time value of money concept is one of the most important principles in finance. It states that a sum of money today is worth more than the same sum in the future due to its earning potential. Present value, PV. The current value of a future cash flow, discounted at a specific rate. Future value, FV, the value of a cash flow at a future time, assuming it grows at a specific rate. Formulas: FV equals PV times 1 plus R, caret N. PV equals FV, 1 plus R, caret N, where R equals interest rate or discount rate. N equals number of periods. Example: if you want to invest $1,000 today at an interest rate of 5% for 3 years, the future value of this investment is FV equals 1,000 times 1 plus 0.05 cubed equals 1,000 times 1.157625 equals $1,157.63. Applications: calculating the value of an investment today, present value; estimating the future value of savings or investments, future value, blank, underscore, blank. 2. Discounted cash flow, DCF, analysis. DCF analysis is a method used to determine the value of an investment based on its expected future cash flows. It is a core technique in finance for valuing companies, projects, and investments. Formula: DCF equals C1, 1 plus R, caret 1 plus C2, 1 plus R, squared plus CN, 1 plus R, caret N. Where CN equals cash flow in the north period, R equals discount rate, N equals number of periods. Example: if a project generates cash flows of $500 per year for the next 5 years and the discount rate is 8%, the present value of the project would be calculated using the DCF formula. Blank, underscore, blank. 3. Statistical concepts for CFA. In CFA, understanding statistics is key for evaluating risk, return, and trends in financial data. We will focus on mean, the average of a dataset; median, the middle value when data is ordered; standard deviation, SD, a measure of the dispersion or variability of a dataset. Key formula for standard deviation: SD equals square root, sigma, xi mu, squared, n, where xi equals each data point, mu equals mean, n equals number of data points. Standard deviation is crucial for assessing the risk of an investment. A higher standard deviation means more risk, more fluctuation in returns. Blank, underscore, blank. 4. Probability concepts. Probability theory is fundamental for decision-making under uncertainty. In finance, it helps assess the likelihood of different investment outcomes. You will encounter expected return, the weighted average of possible returns, where each return is weighted by its probability. Variance and standard deviation, measures of risk or uncertainty. Example of expected return: if an investment has a 50% chance of returning 10% and a 50% chance of returning 5%, the expected return is expected return equals 0.5 times 10% plus 0.5 times 5% equals 7.5%. Blank, underscore, blank. Recap what you learned in Lecture 1. Time value of money, TVM, is crucial for valuing investments. Discounted cash flow, DCF, is used for investment and project valuation. Statistical concepts like mean, median, and standard deviation are essential for financial analysis. Probability helps assess potential outcomes and risks. Blank, underscore, blank. Mini quiz. Answer before Lecture 2. 1. What is the formula for calculating the future value of an investment? 2. What is the significance of standard deviation in financial analysis? 3. How do you calculate the expected return of an investment with different probabilities? Once you're ready, say, ready for Lecture 2, and we'll dive deeper into hypothesis testing and regression analysis. Keep up the great work. Let's move on to Week 2 Lecture 2, Hypothesis Testing and Regression Analysis, blank, underscore, blank. Lecture 2, Hypothesis Testing and Regression Analysis. In this lecture, we will cover some key statistical concepts that are essential for analyzing data and making inferences about financial markets. Understanding hypothesis testing and regression analysis is crucial for CFA candidates as they help evaluate investment strategies and risk. Recap what you learned in Lecture 2. Hypothesis testing helps you assess whether a claim about a population parameter is supported by sample data. Regression analysis is used to understand relationships between dependent and independent variables in finance. R-squared measures the goodness of fit of a regression model, and multiple regression allows for analyzing multiple factors at once. Blank, underscore, blank. Mini quiz. Answer before Lecture 3. 1. What is the null hypothesis in hypothesis testing? 2. What does R-squared represent in regression analysis? 3. How do you interpret a coefficient in a linear regression model? Once you're ready, say, ready for Lecture 3, and we'll dive deeper into correlation and time series analysis. You're making excellent progress. Keep it up. Let's move on to Week 2 Lecture 3, Correlation and Time Series Analysis, blank. Lecture 3, Correlation and Time Series Analysis. In this lecture, we will cover two important concepts in quantitative methods, correlation and time series analysis. Both are essential for understanding relationships between financial variables and predicting future trends in investment analysis. 1. Correlation. Correlation measures the strength and direction of the relationship between two variables. In finance, it is often used to understand how the returns of two assets are related. Correlation coefficient, R. The correlation coefficient ranges from -1 to +1. OR equals +1, perfect positive correlation, as one variable increases, the other increases. OR equals -1, perfect negative correlation, as one variable increases, the other decreases. OR equals 0, no correlation, no linear relationship. Formula for correlation coefficient, R equals sigma, xi, x, y. Square root, sigma, xi, x, squared sigma, y, squared, where xi and y are the individual data points for variables x and y are the mean values of x and y interpretation. A high positive correlation, close to +1, suggests that the two variables move together in the same direction, e.g., stock returns and market returns. A high negative correlation, close to -1, indicates that the two variables move in opposite directions, e.g., stock and bond returns. A correlation near 0 suggests no significant linear relationship between the variables. Example, you want to determine the correlation between the stock returns of two companies, Company A and Company B. After calculating the correlation coefficient, you find R equals 0.85. This indicates a strong positive relationship between the two companies' stock returns. 2. Time series analysis. Time series analysis involves studying data points collected or recorded at specific time intervals. In finance, time series data is often used to analyze trends in stock prices, interest rates, or economic indicators. Trend analysis, identifying long-term movements in data, such as increasing or decreasing trends. Seasonality, identifying regular, periodic fluctuations in data, such as quarterly or yearly patterns. Cyclic patterns, long-term fluctuations that are not periodic, often influenced by business cycles or economic events. Components of a time series. 1. Trend, the long-term direction of the data. 2. Seasonality, regular patterns or cycles that repeat at fixed intervals, e.g., monthly, quarterly. 3. Noise, random variation that doesn't follow a predictable pattern. 4. Cyclic movements, longer-term fluctuations not tied to a specific time frame. Decomposing time series data can be broken down into components, trend, seasonality, and noise. By isolating the trend and seasonal components, analysts can make more accurate forecasts. Example, you have monthly sales data for a retail store over the past 5 years. The time series shows an upward trend in sales, with higher sales every December due to holiday shopping, seasonality. The time series also exhibits some irregular noise, like sudden sales spikes during promotions. 3. Autoregressive models, AR, and moving averages, MA. In time series analysis, autoregressive models, AR, and moving averages, MAR, are commonly used to forecast future values based on past data. Autoregressive model, AR. This model assumes that the value of a variable at time t is influenced by its past values, lags. The general formula for an autoregressive model is OYT equals alpha plus beta YT1 plus beta YT2 plus epsilon t, where YT is the value of the time series at time t, beta are the coefficients for the lagged values. Epsilon t is the error term, white noise. Moving averages, MA, a moving average smooths out short-term fluctuations and highlights longer-term trends. The most common type is the simple moving average, SMA, which averages the past n periods of data. 4. Forecasting with time series models. Once you have analyzed the data and decomposed it into trend, seasonality, and noise components, you can use time series models to forecast future values. Common forecasting methods include exponential smoothing, a weighted moving average method that assigns more weight to recent observations. ARIMA, autoregressive integrated moving average, a more advanced method that combines autoregressive models, moving averages, and differencing to handle non-stationary data. Blank. Recap what you learned in Lecture 3. Correlation helps to measure the relationship between two variables. Time series analysis allows you to analyze trends and patterns in data over time. Key components of time series include trend, seasonality, noise, and cyclic movements. Autoregressive models, AR, and moving averages, MAR, are commonly used in time series forecasting. Mini quiz. Answer before Lecture 4. 1. What does a correlation coefficient of +1 indicate? 2. What are the key components of a time series? 3. What is the difference between trend and seasonality in time series analysis? Once you've answered the quiz, say, ready for Lecture 4, and we'll dive into statistical inference and advanced regression techniques. You're doing a fantastic job, keep it up. Let's move on to Week 3 Lecture 1, Statistical Inference and Advanced Regression Techniques, Lecture 1, Statistical Inference and Advanced Regression Techniques. In this lecture, we will build on the foundational concepts of hypothesis testing and regression analysis that we covered earlier. We will dive into statistical inference and advanced regression techniques, which are crucial for making data-driven decisions and evaluating complex financial models. 1. Statistical inference. Statistical inference is the process of making conclusions about a population based on a sample of data. In finance, statistical inference is often used to estimate parameters such as mean returns, variances, and correlations based on historical data. Confidence intervals, a range of values derived from sample data that is likely to contain the population parameter, e.g., the true mean return, with a certain level of confidence. For example, a 95% confidence interval for the mean return might be 4.5%, 6.5%. This means you can be 95% confident that the true mean return lies within this range. Margin of error, the amount by which a sample statistic may differ from the population parameter. It depends on the sample size and the standard error. Formula for confidence interval, C equals x plus or minus z, sigma, square root n, where OX equals sample mean OZ equals z-score corresponding to the confidence level, e.g., 1.96 for 95% confidence, O sigma equals standard deviation ON equals sample size. Example, if you have a sample of 100 monthly returns with a sample mean of 5% and a standard deviation of 2%, the 95% confidence interval for the population mean return would be C equals 5% plus or minus 1.96 asterisk, 2%, square root 100, equals 5% plus or minus 0.392%. C equals 4.608%, 5.392%. This means you can be 95% confident that the true population mean return is between 4.608% and 5.392%. 2. Advanced regression techniques. In the CFA curriculum, we also study more advanced regression techniques to analyze more complex financial data. Here are two key methods. Multiple linear regression. Multiple regression allows you to examine the relationship between one dependent variable and several independent variables. It can be used to assess the impact of multiple factors, such as interest rates, inflation, and GDP growth, on stock returns. Multiple regression equation, y equals beta plus beta x plus beta x plus beta x plus epsilon, where y is the dependent variable, e.g., stock return. X are the independent variables. Beta is the intercept. Beta are the coefficients that measure the effect of each independent variable. Epsilon is the error term. Example, suppose you want to predict stock returns, y, using three independent variables, interest rate, x, inflation, x, and GDP growth, x. The regression equation might look like OY equals 3% plus 0.2x 0.3x plus 0.4x. This equation suggests that for every 1% increase in the interest rate, x, stock returns, y, increase by 0.2%. For every 1% increase in inflation, X, stock returns decrease by 0.3%, and for every 1% increase in GDP growth, X, stock returns increase by 0.4%. Logistic regression. Logistic regression is used when the dependent variable is categorical, e.g., yes or no outcomes. It is commonly used in finance to model binary outcomes such as the likelihood of a company defaulting on its debt. Logistic regression equation, log p 1p equals beta plus beta x plus beta x plus beta x, where p is the probability of the event occurring, e.g., defaulting on debt. X are the independent variables. Beta are the regression coefficients. Example, if you want to predict the likelihood of a company defaulting based on variables like debt-to-equity ratio, X, interest coverage ratio, X, and current ratio, X, logistic regression could be used. The equation might look like O log p 1p equals 0.5 plus 0.3x 0.1x plus 0.2x. This model would give you the probability of default based on these financial ratios. Blank, underscore, blank. 3. Model diagnostics and evaluation. After performing regression analysis, it's important to evaluate the model's performance. The following metrics are commonly used. R squared measures how well the independent variables explain the variation in the dependent variable. A higher R squared indicates a better fit. Adjusted R squared, a modified version of R squared that accounts for the number of predictors in the model. It helps prevent overfitting. P-value helps to determine the statistical significance of each coefficient. If the p-value is less than a significance level, e.g., 0.05, the corresponding coefficient is considered statistically significant. Standard error of estimate, C, measures the accuracy of the regression model's predictions. Recap what you learned in Lecture 1. Statistical inference helps make conclusions about a population from sample data using confidence intervals and hypothesis testing. Advanced regression techniques include multiple linear regression for modeling relationships between multiple variables and logistic regression for binary outcomes. Model diagnostics like R squared, adjusted R squared, and p-values are essential for assessing the quality of regression models. Blank, underscore, blank. Mini quiz. Answer before Lecture 2. 1. What is the formula for a 95% confidence interval? 2. What does a p-value of less than 0.05 indicate in regression analysis? 3. What is the difference between linear regression and logistic regression? Once you've answered the quiz, say, ready for Lecture 2, and we'll move on to time value of money and advanced discounted cash flow models. You're making great progress, keep it up. Let's move on to Week 3 Lecture 2, time value of money and advanced discounted cash flow models, blank, underscore, blank. Lecture 2. Time value of money and advanced discounted cash flow models. In this lecture, we will dive deeper into time value of money, TVM, and discounted cash flow, DCF, models, which are critical for investment analysis and financial decision-making. Understanding these concepts will enable you to assess the value of investments, evaluate business projects, and make decisions on long-term financial planning. Blank, underscore, blank. 1. Time value of money, TVM. The time value of money is a fundamental principle in finance, which states that $1 today is worth more than $1 in the future due to the potential earning power of money. This concept underlies the idea of interest rates, inflation, and opportunity costs. Key concepts: present value, PV, the current value of a future sum of money, discounted at a given interest rate. Future value, FV, the value of a current sum of money at a future date, compounded at a given interest rate. Discounting, the process of calculating the present value of a future amount. Compounding, the process of calculating the future value of a present amount. Formula for present value, PV, PV equals FV, 1 plus R, caret N. Where, OFV equals future value OR equals interest rate, or discount rate, ON equals number of periods. Formula for future value, FV, FV equals PV, 1 plus R, caret N. Example, if you invest $1,000 today at an annual interest rate of 5% for 3 years, the future value would be FV equals 1,000 asterisk 1 plus 0.05 cubed equals 1000 times 1.157625 equals $1,157.63. If you were to reverse this and find the present value of $1,157.63, using a 5% rate in 3 years, PV equals 1,157.63, 1 plus 0.05, cubed equals 1,157.63 divided by 1.157625 equals $1,000, blank, underscore, blank. 2. Advanced Discounted Cash Flow, DCF, models. Discounted cash flow, DCF, is a method used to value an investment or business by estimating the present value of its expected future cash flows. It is widely used in corporate finance and investment analysis. Key steps in DCF: estimate future cash flows. The first step is to project the expected future cash flows, which could be revenue, operating income, or free cash flow to the firm, FCFF. Select a discount rate. The discount rate typically reflects the required rate of return for an investor or the company's weighted average cost of capital, WACC. Discount the cash flows. The future cash flows are discounted back to their present value using the selected discount rate. DCF formula: NPV equals sigma CFT 1 plus R caret T, where ONPV equals net present value OCFT equals cash flow at time TOR equals discount rate, or WACC OT equals time period.